Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about Fed Chairman Jay Powell's testimony in front of Congress today, how to anticipate the anticipation of others, and the latest with CD rates. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Fed Chairman Powell testifies in front of Congress today. What do you expect him to say?
Hey, good morning, everyone. Good morning, Allison. And, I don't expect him to say really much new right now. We get, he's today and tomorrow, he'll have a prepared statement and then he'll take questions. And honestly, I think this will be about the most vanilla, if you will, testimony out there because we're at such a tenuous point. So I think lawmakers are really going to dig for information, and I don't think he's going to give up much because we're at the end of the rate hike cycle. We don't know exactly where we are. But we know we're towards the end, right? There's going to be another quarter point raise at least, and probably one after that. There's some talk of a 50 basis point raise coming up, but I think the Fed's going to avoid that. Art Cashin was on CNBC this morning talking specifically about if the Fed would decide to go back to 50 basis points, that would be portrayed in the media as, well, I guess the Fed doesn't know what it's doing. It was caught by surprise. It had to go back on what it was saying. They're going to avoid that, is my opinion. So I think they will do quarter point raises, really as many as they need. I think 2, maybe it's 3. We'll see. Obviously, the inflation numbers have to support their actions there. But overall, today it starts at, I believe, 9 Central. So it's coming up here pretty quick. And again, he'll be answering questions mostly about the economy, though I'm sure they will ask rate questions, but I think he's just going to simply deflect those with we'll make a decision data dependent. The priority is getting inflation under control, that sort of thing. So what do I expect out of the market? We're in the green this morning. I would expect that the market probably holds green. He'll talk, it'll go red, right? Because, and then it'll go back green again, is generally kind of the pattern with as the market kind of processes the words that he says. And also, there's algorithms that trade these events too. So the volume will tick up there likely while he's talking. But again, he talks today and tomorrow. And of course, everybody will be listening to what he's saying.
Next, it is often said that successful investing is anticipating the anticipations of others. Who said that, and what does it mean?
Who said that? I did. I said it yesterday. I said it the day before and the day before that because it's one of my favorite phrases. So I say this to investors all the time because it makes so much sense and it puts things in perspective. So what does it mean? Well, first of all, who said it? John Maynard Keynes said it in 1935. Okay, which is not exactly yesterday. So this concept's been around for a long time. You can read the note there if you want, or you can Google it, what he actually said, right? But the issue is with markets, and this is kind of a none of us is dumb as all of us, which is another favorite quote of mine, is the open market, anything can really happen. That's why they're notoriously unpredictable. You could have a big player come in and make an oversized bet in one position. That moves that position. It moves all the ETFs that are tied into that position. It can, if it's big enough, it can move the Dow or the NASDAQ or the S&P 500. So to really think about events that are occurring. So like right now, the number one event we have is the rate hike cycle, right? We're over a year into this. We're over a year into the bear market. We know it's going to end. It's going to end at some point. We just don't know when, right? So when you hear me say the phrase, I'd rather be, 3 hours early than 3 minutes late, it's kind of getting to this. So what it's saying is there's the event. So the last rate hike, the market should go higher after the last rate hike, right? Because we're done. When the Fed says, okay, that's the last one, there's no more. Well, there's people that are anticipating that are going to move the market, right? So the people that are in front of it, for a few weeks or, months or however long it is, they're going to move their money first, and they're going to get an advantage over everybody else that waits. Well, if the data point is here, and then you back up to where the professionals or the people that are anticipating things are actually going to make their move. Your best bet to outperform is to be slightly prior to that. So that's where you get the anticipating the anticipations of others. So get what the market thinks is going to happen, back that up to where you think the money is going to flow in, and then go that much earlier, right? Obviously, there's a lot of art to that. Millions of dollars are made and lost in trying to correctly participate in that. However, that's what money managers are trying to do, at least the active ones. The passive ones are just blah, right? They don't care about any of this stuff. But for anybody that's paying attention to the markets and wants to actually, try to get in front and achieve alpha from these situations, much like we did in the COVID sell-off with the lock and load brief in March of 2020, is you try to get right there and then you make your move. So it's never going to be perfectly timed. But I will say that, for folks that I'm putting money for work for right now, it's like we're in early. We know this is coming. I think it'll happen in 2023. It could happen as early as June of 2023. But I know that I don't want to be late because the move traditionally has been significant. So look at the snapback we came out of COVID. Look at the snapback we came out of 2007 through 2009. Look at the snapback we came out of the tech crash of 2000, right? So you don't want to miss the snapback. And that's why if you're on the sidelines, that's a tough place to be, because by the time you feel comfortable moving back in, you've left 15, 20% on the table. So again, John Maynard Keynes, if you have college economics, you're going to come across his name and study some of his Keynesian theory. It's better, it's good to understand just the basics of that, is what most people know. But just realize he's the one who actually said it. It's been credited to a lot of people along the way, but really that's a general, the hardest thing to do. But if you're successful at it, you get rewarded significantly if you can be slightly in front of the wave.
Last, how high are CD rates now?
Well, here's a chart of the CD rates. Again, they're very popular right now. I'll get it up here in a second. Here we go. There it is. All right. So here we are. This is Schwab Advisor Center. This is my personal login, and here are your current CD rates as of this morning. So you see the CDs, and then you're off into bonds. The two types of CDs out there. You have your non-callable and your callable. As you can see, or if you don't know the difference, so callable means a bank can issue a CD and then change its mind. So say the 5-year callable's up to 5.25%. Say 2 years from now rates drop. Well, with a callable CD, the bank simply buys that back from you and you don't have any say over it. A non-callable CD is you own that to maturity, right? The bank just can't change its mind and go away with it. So you can see in the short term, 6 months or 9 months, there's actually no difference in the interest payment. If you get out to a year or 2 years, you can see a slight difference. If you get out to 3 or 5, and now you're talking, 0.25 and quick math, 0.65%, just for that premium. And again, I like to buy the callable stuff because you know what? I'd rather have the extra payment. And if the bank changes its mind, I can change my mind too, right? Because, they retire that CD and then all of a sudden the $10,000 or whatever you had in the CD comes back into the account. We're done with that. We're moving on, and we go with the next best thing. So I don't mind that at all. Some people do. Some people want the longer term benefits of it. So overall, the question Allison asked was where are CD rates? You can see that if you get out into this kind of sweet spot of the 1 year to 2 year, there are 18-month CDs out there that you can get that 5.35%. I'm telling you, every day that's more and more attractive. The money that's flowing in. There's two folks, the people that are buy tech low, saying, here's some money, I want you to take advantage of the sell-off. And there's the wait and see folks, which are the, let's just go into a CD, call it good, nice return. We came off of 2020, which was just continuous punches to the face. So it's like a little tired of that right now. Let's lock it up. Let's get 5% and reassess once this is all behind us. So overall, it's very attractive if you're interested. Like I said, you can go to your bank and do it, but you'll get about 1% less. So anyhow, if you're interested in making more, give us a call.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar. We'll see you back here tomorrow.